Hi everyone, it's awesome to be here today with the rest of the TradeThirsty team. Been lots of great discussion about all kinds of awesome indicators and systems, and I'm going to teach you about something that I've used every day for years and years. That's in all of your trading systems or free software, whatever you use to look at the market, but that's just generally so underused. And you'll walk away with knowledge that you can apply to the markets and to improve trading right away, again, using a very commonly referenced indicator. And I know that everything's running behind a little bit here, but it's afternoon here in New York on a Saturday, so I want everyone to follow along with me right now, okay? Just take your hands off the keyboard, drop the pen and the paper on the side for a moment. Take your hands, wiggle your fingers a little bit, okay, get loose. Put them up over your head, and then just cross them back behind, okay? Because for the first few minutes here, you will not need to write anything down. You just need to listen, all right? So take this break. I don't know if you're getting another one with the other speakers, so I'm giving it to you to let your brain kind of catch up with all the awesome stuff you've been learning. And we will dive right in. So before we get to the fun stuff, disclosure, disclaimer, as you know, trading involves a great amount of risk, and it is your responsibility to evaluate any information, opinion, advice, or other content that is here in my presentation today. Now, this is me. You saw me on the intro page and the sign-up page for this event, Hema Reddy, CMT, and I have been studying financial markets for over 15 years. I was actually first introduced to the markets by my late father when I was just a teenager, 16 to be exact. And he was a doctor, but he traded in his retirement accounts very actively. He traded commodity futures, a lot of the grains. He traded individual stocks, and he traded the E-mini S&P 500 futures. So I was super inspired by everything I learned about him as a teenager. I always had a thing for numbers and math, and I thought this was a great way to take my career. So I left my home state of New York and went to college at Indiana University. I studied really hard, and I graduated. And then when it came to actually learning about the markets, trends and candlesticks and all that fun stuff that I'd seen him show me, I learned next to nothing. And so we had an agreement. I could move back home. I'm not a millennial. This was before this was normal. But I moved back home on the condition that he would teach me about the markets, and I'd work part-time, and together was sort of like a self-made grad school of trading and investing. Now, does anyone recognize this man? Let me see. Make sure I got my chat box here the way I can see it with you all. Any guesses on who this is? All right. I want to make sure I'm getting the actual chat box in here.
You should see questions, like pop up in your questions box.
Yes. Okay, thank you.
And you'll see all the responses. They're pouring in.
Oh, okay. Well, let me just give myself a little... Guys, oh yeah, I see them. Great, excellent. I do
There's
see
a lot of guesses.
Yeah, I do. There are a lot of guesses. Okay, thank you for that. So yes, this is WD Gann. I see the guess of Jesse Livermore. You're close, kind of similar time frame, and Dow and all kinds of stuff. So yes, the black and white photo. Yes, it gives it away. But WD Gann. Now, this gentleman actually traded in the 1920s to the 1950s, and also wrote a lot of books on stocks and investing. And his work is what my dad kind of built his trading systems around. So that's what he decided to introduce to introduce me to the markets. And he gave me this book called How to Make Profits Trading in Commodities. And he told me to read it and learn about how the markets actually work, because even though this book was written so many years ago, they haven't changed, right? Human nature hasn't changed, so the underlying way the markets work didn't change for a large part. Now, my dad also set me up with TradeStation software, because that's what he'd been using on his own for charts and trading for years. He said it was the best, so I trusted him. And he told me to spend time watching this specific market, the E-mini 1-minute bar chart, right? Not candles, not a single clothesline, the bar charts. And he said that this was going to be the best way for me to really see what I was learning about in Gann's book come to life. Now, he had one stipulation for me. He said I had to watch it for, on and off, but 3 hours a day, every trading day, for an entire month. So 28 trading days on average. And as a young kid out of college, you can imagine to have time span for over 5,000 minutes of something that was very passive was a bit challenging. But again, he insisted that I do this before he'd teach me anything else. So every day I'd wake up and I'd look at the open at 9:30, watch on and off till 4 p.m. And something crazy happened. I did start to see these signals and these rules that Gann was writing about come to life on the chart. So when I'd come back to the chart, I'd see these buy signals emerge, and I'd see sell signals show up, and I was like, oh, I guess I'm learning something. At the same time, what I did was I would draw out on paper graphic illustrations of the concepts in Gann's book, because a book printed in the early 1900s did not have fancy digital images and super cool Photoshop things to help us learn. It was very dry, and you had to imagine a lot. So by doing these images like these and these, and then taking them and turning them into these computer graphics like you see here, it was a really great way for me to learn and to keep these images as a reference at my desk to recognize trading signals more and more. Now, I decided to take things up a notch, and what I did was I started writing these little market newsletters. So this is a screenshot of an actual email. You can tell it's old. It's got my maiden name, and it says 2005 on it, of an email that I sent to my dad saying, hey, I've been watching the market, and this is one way that I kind of strategize. After the close, I look at what's going on, I write about it, and then the next morning I take a look at it. So, of course, he was like, hey, start sending these to me. So in 2005, I started forwarding them to my dad every day. I called them the skinny on the mini because, hey, it's the E-mini, and I'm trying to get the lowdown and the key points of the day. So that was the name I coined, and I started sending them out on a regular basis. Now, all this time, I did find interest in trading, but my real goal was to be an analyst, and I wanted to be a professional technical analyst on Wall Street. So I got super busy studying for something called the CMT. You may have heard me mention those 3 letters after my name. Now, does anybody out there know what the CMT is? It's got a little bit of a long name to it, but I will eliminate some options for you. It is not country music television. That's the first thing that comes up when you Google it. It is not a certified massage therapist, although that would be quite fun. But yes, I'm seeing some correct guesses here in the list. It is chartered market technician, right? So this is the designation that is put out in the Wall Street realm by the Market Technicians Association that kind of stamps you as official professional technical analyst and kind of opens the doors for the industry. So when I was really busy studying for these exams, there were 3 exams over 3 years, I'd still write the skinny on the mini, and I would forward it to my dad. And then after a while, he was telling me that something really interesting was happening. Even though I wasn't there to kind of follow up on each move I wrote about and like sitting there with him during the day, he started applying a lot of the tools that I was discussing in the analysis, and then he was making winning trades off of it, trades that he probably wouldn't have thought to take before. So we were both super excited. I mean, I was able to help him increase his level of trading success by using knowledge that he had introduced me to. I think for any parent-child relationship, that's pretty much the dream. And so I continued on, got my CMT, and then I went on to work on as an analyst at an independent firm in New York City for several years. Then in 2010, I got my own chance to write a book on technical analysis, specifically on the analysis that Gann wrote about. And it was like a primer. It was meant to be an intro for anybody looking to get into deeper study of Gann's work. And it took me 18 months to write, okay? That is twice as long as being pregnant. I have not been pregnant yet, but I hear that's tough. Imagine how 18 months feels. But the good news is it was published in October 2012, and this was a huge deal for me. And it also made my parents super happy as well. Can't forget to give Mom the credit for raising me and all this, even though she doesn't really give a hoot about the charts. Now, with my skinny on the mini, I had been sending to my dad, right, all these years. And then now I had published this book, and I wanted to keep people engaged and on a continued path of learning. So I started sending it out to people who read my book and would reach out to me via my website. My website has never changed. It's the same one that's printed on the inside jacket of my book. I also started to include people on the list who were attending different webinars and lectures I was doing, that my publisher set me up with, or I was getting connected through the MTA and doing. And then, of course, there were all these professionals that I had met who were using technicals day in and day out, and they were getting my newsletter as well. So I had quite a base now, and people kind of relying on it, but it's still free, just a kind of extra bonus in their inbox every day. Now, life took my husband and I out to the Midwest. We moved to Minnesota, and my husband, pictured here, is from Wisconsin. So anybody who doesn't know the Midwest too well can see that those are neighboring states, and we thought we'd be settling there for a while. In fact, as this photo shows, my husband was extremely successful in converting me into a t-shirt wearing, bratwurst eating, Green Bay Packers football fan. Right? He is very, very proud of that, and he knows that I'm referencing the Packers in this presentation, and super thrilled by it. But we thought we'd be settling in Minnesota, and the constraints of my new job there, I worked at an investment bank, focusing on technicals, mostly in equities. This didn't allow for me to have any sort of independent research. So I had to come back to my crowd. So now I had all these people who had been getting the skinny on the mini, and I had to tell them, hey, I can't send this out anymore. I got this full-time gig, and it's just not going to allow for it. And they were really, really bummed. And the reasons started spilling out. They started telling me about all the different parts of my analysis that they were using, getting for free every day, and it was helping them make real money in the markets. The good news for you today is that among these is the indicator and the approach that we're going to dig into. Right? So now, moving on, in 2016, my husband is a cancer surgeon, very high level of training, part of the reason why we moved around quite a bit, but he got a super amazing job opportunity back in my home state of New York, but up in Western New York, in Buffalo, which is where I am now. And in the process of leaving Minnesota, I left my sell-side analyst role, and by the summer of 2016, I decided to bring back the skinny on the mini, for good. So what I did was I reached out to all my former subscribers, and I said, hey, I will offer you this newsletter now for a monthly subscription fee. And they started happily paying me for it. So I repeat, people started paying me for something that they used to get for free. That is how valuable the research was to them. And they started asking more about, hey, how do I learn how to analyze the market the way you do, Hema? Or how can I use this information to address stocks and markets outside of the ES? And this is what led me to being here with you today. So all this time and all these years, I've kept in mind one of the lessons my dad used to remind me of all the time, and that was to always remember the KISS method. Keep it simple. I want everybody to fill in the blank here. I can't be the only one who's heard of this. So what's the last S in the KISS method for anyone who's heard of it? Any guesses? Okay, so yes, I see the very common guess is stupid, but my father, being a man who wanted to instill positive wisdom and positive attitudes in his 4 kids, say keep it simple, smarty. And the reason being that he actually used to teach me and say, look, it takes a lot more level of understanding and intellect to explain things with less than it does with more. So to dig into what we're going to be looking at today, in order to emphasize the importance of the concept behind the indicator. Okay, we've seen a ton of indicators today with all these great speakers, systems, tools. But in the case of what I want to teach you, it's important to understand A, why it's important, and then B, the underlying mechanics of how it works. And then I'll show you how you've been looking at it all wrong. So to get started with this very high-level explanation, please, this graphic, it might surprise you, but this is the way we need to start with things. Right? Yes, it's a rubber ducky. I don't know if everyone in all parts of the world is familiar with this. I think of Ernie and Sesame Street every time I see this image. But this duck and the other ones that are going to be in this path I'm taking you through represent different parts of the trader's process, if you will. Right? So now, another show of hands. How many of you, now keep in mind, I just want you to type a yes anytime any of the next few slides actually resonate with you. How many of you start your day doing some or all of the following? All right, you turn on the TV while you're having breakfast or getting ready. You listen to the radio if you drive into work. You then start checking your phone and all your different apps for the information about the day. Sit down to your computer. I mean, I think very few of us are trading without being in front of a PC, But it's not just that you sit down to your computer, you start checking email and websites for the news of the day. It's all about getting the news, right? That first kind of push in the morning. You need to know what's happened in the world. And sadly, in this day and age, you need to know, am I waking up safe? Did something blow up somewhere? I mean, it's really a serious issue. So I get it, right? I do this too. And the thing is that even if you do just one of these things, you realize how important it is to know what's going on in the world. You know, are there any big economic reports coming in, key political events? And that's perfectly fine and absolutely useful. But it's a little duck. The next little duck, right? I'm getting a lot of yeses here. Yeah, I got 5 Ys in a row. I love it. I think that means you're acknowledging that you use every single bit of media that I showed an image of. All right. Now, do your next steps, okay? After you've like absorbed all this news and your brain is starting to churn, do you then go study? You go pull up a report that you subscribe to. You go pull up your charts. You know, now you're getting into the specifics of the market. And you're trying to figure out, hey, is it the bears or is it the bulls who are in charge right now? How are things looking, getting ready for the start of this session? Okay, I'm getting a lot of yeses here. This is analysis mode. Again, as traders, as investors, as humans, this is all important to the big old picture process that we're doing. Now, if you're like me, all right, you see this third little duck, and you see this chart, and you see an indicator, but this indicator is just one of many you could pile on. I don't necessarily advise this, but in one of the jobs that I've had in the past, I was mandated to not just have one indicator like this, but not just 2, but 3 different indicators on every chart I would publish about at any moment. And it kind of drove me crazy, but hey, that's what the clients wanted, so that's what my boss told me to do, so that's what I had to do. And I totally believe that there's value in studying everything from volume, right, the number of shares traded, to market sentiment. That's where you're polling whether it's bull or bears. Volatility, I'm sure we hear that term tossed around every day. Because when used correctly, all of these different indicators can help us better understand what's going on in any particular market or security at any given moment. But now you see here, right? The catch is that all these things, the newsletters, the analysis, the indicators, they're all the little baby ducks. They are not the major force to be reckoned with. And they all point to one big thing. And if you follow the little ducks, okay, just like, you know, I grew up in Long Island in New York, in the South Shore, if anybody, do we have any New Yorkers in here? I didn't ask the most important question. Any New Yorkers? But if you are, just answer me with an NY and I'll know. But I grew up in the southern part of Long Island, and my backyard has a canal that leads right into the Atlantic Ocean. It's pretty awesome. So I saw a lot of sea life growing up, and I would love feeding the ducks that would come along the way. My father would warn me, he'd say, if you feed them today, they will show up tomorrow and want more, but I don't listen. So my sisters and I especially kept doing this. And we would notice this, right? Mama duck's there, baby ducks are there. Once in a while, the baby ducks, they would like not know what they're doing and go off track, and then they start freaking out because their mom is going to take them to food. Their mom's going to take them to shelter. Their mom's going to get them in and out of the canal. In the same way, all right, we as traders, as analysts, as investors, we need to follow the mama. Awesome, I'm seeing a lot of representation from Long Island here, all right? And so to follow the mama, who is mama, is momentum. And to follow momentum is to follow price, right? So this is crucial to accept the importance of momentum as a secondary tool on top of analyzing price. Now that we all got that down, how does momentum work? Well, now let's revisit my college days. I mean, who doesn't want to do that? So anybody remember where I went? I said to school. Where I said that I went to school. You can type in the initials if you know them, or the name of the state. Very good. Love the listening. Oh, Wisconsin. That's where my husband's from. He's a Badger. I'm a Hoosier. Very important distinction. Okay, great. So you all paid attention. I went to school in Indiana, attended Indiana University. Go Hoosiers. Now, every summer, I would happily come back to New York. The Midwest was great, but you know, I needed my friends and my family and everybody back around me. but I had a lot of friends who were from Indiana, Chicago, etc., who every summer would be really excited because they'd either be attending or working the Indianapolis 500 car race, better known as the Indy 500. Now, it doesn't matter what you know about car racing, you most likely know how a car works, and so we're going to just take this scene to explain how momentum works. So start by putting yourself in the starting seat. You pick up pace as you go through the starting line. And this orange line here represents your acceleration. Okay, you've got to gain speed so that you have a leg up in this race. Now you see a curve coming, right? I think there's some sort of drawing tools I can use here. All right, Jeanette? Oh yeah, I see them. You don't need to come on and yell at me. All right, so we got this highlighter. Okay, we see this curve that's coming around the bend. Now, when you see the curve coming and you're driving at speeds like this, it's not that you're going to stop and get out and turn your car around, but your speed, the rate at which your speed is increasing is going to slow down. Okay, so that's what that second arrow is for. Now after that, this tool here. Oops, sorry. Okay, you're going to come around the bend and be slowing down. So here, you come around the bend, you slow down, and then you have to pick up speed again. All right, so let's make sure we got this. You start, you could say it's 0. You pick up speed, you slow down for the turn, you pick up speed again, and then you're well on your way, okay, coming down the other straight path. This is how you manage that turn without flying off in the end. Is everybody following this? Give me a couple whys out there if you get this, whether you drive a car or not. And I have a lot of friends in New York City who've never been behind a wheel. But you understand deceleration and acceleration. Yes? Great, awesome. If you get all this, then you understand momentum, even if you haven't looked at it before today. Okay, take that same racetrack we just looked at, and now pretend you're in that helicopter that was in that first piece there. So you're looking at this from a bird's eye view, right? You're looking down at the track, and this exact set of motion becomes price, and then momentum usually is plotted underneath it on a stock chart, futures chart, whatever you're plotting. And here is how they work together. Generally, when you have prices in an uptrend, you have rising momentum. Okay, so force behind that trend is increasing to the upside. And generally, and I saw somebody answer this in the box here, they said momentum leads price. You know your momentum. When you see momentum peak and price hasn't peaked yet, usually, okay, it's not 100%, but usually that's your first signal that the price trend might be slowing down. So it kind of gets you on guard and gets you ready. We've heard a lot today from a couple speakers about the market getting ready for a big correction or blow up or a bubble or all these different things. Whether you agree with that or not, whether it's happening right now or not is not important. What's important is that you realize that momentum is probably the most important tool that you can use to help you see when that turn, that shift might actually happen. All right, so you make the turn and now you're in a downtrend. And in a downtrend, your momentum indicator is falling. And they're moving in line together, and the force of the downside momentum is increasing as the downtrend matures. And then again, just like on the top side of things, here, before you see price bottom out, you will often see momentum bottom out. So it's literally a leading indicator giving you a heads up on what's coming. How many of you use, not momentum necessarily, but let's say moving averages? Who actually use them? I want to hear a yes if you actually, just type MA if you use moving averages, so I know. Okay, I love moving averages for awesome, okay, determining the trend that's underlying, but we all know that moving averages, even exponential ones, are lagging indicators. So it's super important. Can you guys hear me okay? Somebody said no sound, so I just want to make sure. Okay. I guess Jeanette will yell at me if
I'm sitting right here.
Okay, just making sure. No problem. Okay, thank you. All right, so momentum gives you a heads up, whereas there's quite a few lagging indicators out there that, you know, are useful to determine things but don't get you in ahead of the next step. All right, now we come to the most favorite part of this presentation for my husband when I practiced on him, and actually something that I've used to better understand momentum and use it the way that I'm going to show you today. the game of football is a great analogy for explaining why you've been using momentum all wrong and how you should be using it. So, anybody remember who my husband's team is? The football team, American football, that he's a big fan of? Anybody? Yes. Oh, Dallas. Oh my God, I can't even stomach that guess. Sorry, no. Packers, yes. Green Bay Packers all the way. Great. So that is my little representation of the Packers here. As you know, if you're a football fan, the NFL is like super particular about their stuff being used. I didn't even want to try to search stock photo for a Green Bay Packers logo, so this is the closest guess. If you ask me, he kind of looks like Aaron Rodgers, so I think it works. But now, the Packers' biggest rival. Who knows that? There are a couple big ones, but I would say historically, their biggest rival. Yeah, it's like that whole Midwest division, but I agree, the Bears. And look how beautiful this is, okay? Nobody's going to call, I'm not going to get in trouble, no phone calls from Roger Goodell or anything. But I still get to use football to explain the importance of momentum to you. And again, how you need to use it versus what you've been doing. So everybody take this football field for a second. I presume that we have some people in this audience who are not football fans, who've never watched it. I know, all right, it's okay, I used to be you. And all I need you to know is this following. In order for either of these teams to score any points, first, they start on opposite sides, all right? They might be starting at the 40-yard line, depending on where the last set of plays ended. Or they might be starting on the other 30-yard line. That moves around, okay? That's why you always see them hunched over and starting at different points. The important thing is, every time that they want to score points, their job, whether you're the Packers or the Bears, is to move to the other side of the field. Oh my God, somebody said their dad played for Green Bay. Okay, side note, you're going to have to email me later and give me the scoop on that because awesome, huge fans. My brother-in-law actually had his wedding reception at Lambeau Field last year. This is what I married into. So, side note, but all right, back to the Packers and Bears. Packers need to get to the other side. They need to get through the defense and get to their end zone to score. Again, if you don't know football, it's super easy in terms of how you score points. The basic ones are a touchdown, where you get points by running or catching the ball in this end zone, this last stretch, or a field goal where you just kick the ball through these two posts at the end. Same thing for the Bears, all right? They've got to find ways to get around the Packers and make it to their end zone. So each team is going for a different side of the field, and then at halftime they switch sides, but they're always going for that opposite side of the field. Is everybody following this football analogy? Not do you know football, but do you follow my point here, okay? Two different sides trying to get to two different sides. Great, awesome. Now, take everything I just showed you and flip it on its head, okay? So when you've got this same image here, the 0 to 100 is actually, and I don't have to make this up, this is how football is the green space on this field. Now, in order to sneak it into my momentum analogy, we're going to expand the 0 and 100 out to the edges, so bear with me. But we're going to take that whole thing and plop it on this chart. And now we've got the relative strength index, which is a very commonly known momentum oscillator, which is something that, again, you've all been using wrong. It's not your fault. I'll explain why. Now, the standard setting, as you see here, is 14 periods, okay? This morning, Hubert was talking about, I believe it was the ADX, and he mentioned a gentleman named Wells Wilder. Mr. Wilder invented a lot of different things, and he also invented the RSI in 1978. Okay, that was before I was born, but I've known about it forever. And he set it up to have this 14-period setting. So on a daily chart, it's 14 days. It was an hourly chart, it would be 14 hours. We don't mess with the 14, all right? I'll come back and explain why. The standard rules are that when you're trading with the RSI, you have this zone at 70 above, which is called overbought, meaning that there's been excessive buying into this market, and now the power of buying is sort of running out. So here would be setups for sells, okay? You don't just sell because it got there, but that's the general setup for sell. And this chart just happens to be an E-mini S&P daily chart, or the continuous contract. And you can see, obviously, we've been in a pretty steady uptrend, except for, the election, the U.S. election low, which was back here, I'll just highlight, okay, everybody knows that was a very strange day to look at the charts in the overnight. But after Trump won, things happened to rally, that surprised a lot of people, and then we took off from there. Now, that's a deal with the upper part of this zone. Moving on to the lower part of the zone, we've got oversold. So in this situation, you're saying all of this selling power, right? All that downside momentum has run out, and now if this indicator falls below 30 and comes back up, well, that's a buy signal or part of a buy signal. This is, again, the very traditional approach. Here's my beef with this. The general consensus is that this is only useful during trading ranges, okay? This is an indicator that I had to study inside out when I took those CMT exams. Like, whether I liked it or not, I had to study this and most of what you've learned about today. But again, I learned about all these indicators in the very standard, how they were initially designed capacity. And I think it's safe to say that people who invent these indicators are very brilliant people, and they present rules with them. But that doesn't necessarily mean that that's all the ways in the universe that you can use it. And so what bothers me here is that if this is only useful in trading ranges, it means, hey, nothing to see here, folks. S&P, freaking the whole equity complex is an uptrend for the most part when you look at indexes. So then what are you supposed to do with the indicator? Is it garbage? Throw it away from your chart? No, and I'll show you how to fix that. The other issue with this is that people say, well, the signals are short-lived. And that I actually agree with as a little bit of a downfall, this indicator in the traditional OBOS sense. Because here, look, you get to 70, you come back down, okay? The way that it's plotted right now is the way that my TradeStation plots it in default. I didn't mess with it. It does this green, it does this red, it does this blue. So the red here shows that you've got this value above 70 and then you come back down. And you can see that happens a couple of times. And during those instances, yeah, they were overbought conditions, and then the market came back below 70, but it wasn't really a great time to sell, or necessarily even the best time to exit your long. So how do we fix this? I mean, what do we do? Well, my approach is this. When it comes to using only the standard overbought, oversold approach, I'm calling BS. Okay, no offense to Mr. Wilder, no offense to anybody who's ever used it this way. I just think there's so much more to it. And here is what I'm going to show you how that works. Come back to football one more time, I promise, okay? I know we have probably non-football fans in here, but take that analogy I gave you, or metaphor, or whatever. Remember the Bears, okay? So the Bears are this team up here who have to get down to their orange end zone to score. The market bears can actually push the market to much deeper oversold levels than in normal market conditions or in sideways market conditions. So the actual resistance that they come up to is lower because they don't get things as overbought. They come in and fight and take prices down at lower levels. So this is where you can start to take your paper and pen back, all right? If your hands are still crossed and back behind your head, I'm flattered that you found this so relaxing and engaging, but it's time to get to work again. So take your pen and paper and put this down. Power zone, RSI power zone. Bear resistance, 55 to 65. Okay, this 0 to 100 has not changed. The 14-day setting has not changed. So what this is saying is that in a bear conditions or in a situation where bears are in control, they actually generally find resistance between 55 and 65, not up at 70. And they generally form support further down, more like 20, right? 20 to 30. Not just, hey, let's dip below 30 and come back out and call it the end of the bear move. So take a second and jot these numbers down. You're going to see them several times, but I just want to make sure you have them on paper so that we don't risk, ending the webinar and you haven't gotten them. All right. Now, we've got the market bulls. Okay, bull resistance power zone is 80 to 90 because the bulls can take the market higher to higher overbought levels because their force is with them. The upside momentum is going to get strong as this trend matures and actually push things even beyond. So 80 to 90 is where we anticipate resistance for a bull move. And because of that same situation, they don't need to come all the way down to 30 to be considered oversold and then get a buy signal. Many times they actually find support between 40 and 50. So you've got your bear zones, that was the 55 to 65 resistance, and the bear support was 20 to 30, and now you've got your bull power zone, 80 to 90 for resistance, 40 to 50 for support, okay? So again, you'll jot these down, but you're going to see them. Now we're going to dig into examples, but first I'm going to show you the custom indicator that I have on TradeStation so that I don't have to like mentally make these decisions every time I look at my RSI. I still kept it at 14, but here you'll see, okay? And something that I do when I teach a new concept is I cover up everything on the chart that's just like not relevant to that moment. So I want you to pay attention to the left side of the screen. Pretend that this is the trading day unfolding, or the trading hour, or whatever it is, okay? So right now we're on an ES 60-minute chart, and here we go. So you've got RSI HEMA, that's what I named it, okay, in TradeStation, and it starts out with the bear support zone being these two red lines on the bottom. So see how 20 and 30 come up on the right side axis? 20 to 30 is the bear support power zone. The next two green lines are the bull support power zone. Okay, I took 30 and 70, the plain lines, off my chart. The bear resistance power zone is 55 to 65. Okay, I know I keep saying these numbers over and over, but that's how you remember them easily and can move. The more information you have memorized when it comes to trading and investing, the less you have to spend time looking things up, and then you can act. That's another lesson from my dad. Now the last zone here, 80 to 90. Okay, so this is what you're going to see in all of the rest of the example charts on TradeStation. And we're going to go through a few different markets. Yes, the ES is my baby, okay? I learned about technical analysis and trading on it. I traded it as I was learning. I obviously wrote and write research on it every single trading day. So we have a couple examples in here of the ES, but we also have markets that my traders, my subscribers, my colleagues trade. I know this because I ask them. Anybody in this room who's a current subscriber of mine since getting in the mini probably wonders what I do every time I do a survey. Well, I hope you see today that I'm covering some of the markets you've been begging me to talk more about. So let's just get right in and use this chart as our first example, okay? Walking along. Everybody with me, give me a yes. If you're still in the room, you haven't fallen into your afternoon nap, okay? We're past halftime of the presentation, but we're going to keep it fast and show you a lot of examples. Okay, great, thank you. So in this situation, you can see that the ES 60-minute chart, this happens to be just a chunk of time back in May, roughly a 10-day stretch on the 60-minute chart, rallied. And in this situation, okay, I'm showing you the traditional zone working. It's not a big deal. I mean, it's not me saying, hey, this never works, don't use it. I'm just saying stop limiting yourself to it. So this is a situation where the RSI went above 70, came back down, and that might have been a good place to maybe tighten up your stops, watch for potential reversal ahead, etc. Then here you had a high form in the RSI in the bear market zone. There had previously been an uptrend in place, right? We had, now I got us drawing more, and I will bring a pen in now, okay? So all of this shows we had an uptrend, 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 and then things started to go sideways and not look as pretty. And then we had, obviously, deterioration from those levels. Okay, there's something going on here that I'm going to talk about in a couple slides, but I just want you to get comfortable with the zones first, all right? So we're going to just move through charts like this pretty quickly, but I like showing you a couple different examples on the same chart so you can see how in one particular market this evolves. All right? This move fell down into the bear market support zone, okay? 2666. And that is a situation where you would have, if you use the traditional 30 level, considered overbought, it rallied above 30, and then you would have been like, okay, I think, you know, show's over, maybe you want to buy or something. Ooh, that would have been painful. And the clue here would have been that, see here, the rally off that oversold level didn't quite get back to the bear market zone. Right? It just stayed well below. It didn't even come back above these prior lows and prior highs in the RSI. That would have been the clue that the market is weaker than we think. And then this move continued down, and you've got this low that comes in. And again, something interesting happening here where you've got low, but then this is higher, but then the price is still going down. You know, what is that? And we're going to get to that in a moment. So moving along in ES. Oops, sorry. So here we've got the break of a previous high. This purple line relates to the actual trading signals that I write about in the ES, the trading signals that I used to use, the trading signals that are in the book that I publish. And all that detail can be saved to later. But the point here is that we had a break of a previous high, right? That's what that purple line was marking. And then consolidation, but all that consolidation was hanging out around the bull market zone. And from there, futures took off. They rallied to 75.02 and then came down below 70. If you were sticking to the traditional approach, you might have said, all right, well, I guess this upside moves over. I should be watching out for a sell. But look what happened. All that this did was go sideways for a bit, and that whole sideways time, all right? Now, just so you know, this chart is a 24-hour chart. So if you're in the US here, then you're not necessarily trading all this. But I do have people who get my newsletter who are in the Middle East and other parts of the country, or the world, excuse me. So I trade off 24-hour charts because that's how I learned. My dad said, the real market action, especially now with futures and post-market and pre-market and overnight trading, he's like, you're not giving yourself the full picture when you look at a session-only chart. So I only look at 24-hour charts. But here you can see another situation. Came above 70 and then pushed back down. You would have been bearish the whole time if you were just trading off the traditional. I wasn't, right? I was writing this newsletter using this indicator. So because I had these zones, these power zones at play, I watched all this chop happening, but I knew it wasn't the end of the upside move because it kept finding support above the bull market zone even. And look where it got to. Before it finally kind of exhausted itself, it got up into the bull market resistance zone, 80 to 90, okay? Now, I wanted to remind you here of the signals that unfolded so that you could see that 75.02, the 70.32, those were traditional overbought being 70 and then sell potentially signals. But look at this orange line in price and the orange line in momentum. You see how we moved from the bull market support zone. Okay. So here we moved from 40 to 50, and it just stayed that way. And until it got to the bull market resistance zone, you had a long stretch there, where especially if you're trading and you're not short term, then you could maximize on this. Oh my gosh, somebody's saying I have a Minnesota accent. You know, Jason, I've lived in a lot of different places, and I think between going to college in Indiana, being married to a Wisconsin Badger Packer, and working in Minneapolis, I just don't have an accent. I definitely don't have a Long Island accent except for one word, water. It's not water, it's water, okay? Anyhow, all right, let's move on to our next example. If you guys have questions, please, jot them down for yourselves, and I want you to make sure you ask them. It's just that with everything being delayed today, I want to make sure we cover all the concepts, and there's always room for questions at the end, or you can shoot me an email. But let's keep it moving with the examples, and pardon my growing pains while I get used to navigating the GoToWebinar a little bit. All right, so oil. There's been lots to talk about oil today. We're going to take the oil daily chart that you all probably know and perhaps hate, like me. It's just such an ugly consolidation we've been through. But if you had been looking at it with RSI power zones the way I had, you'd see a couple things that had unfolded in the past several months, going back actually to February of last year. So here again, that purple line indicates the break of a previous high, which was, the beginning hint of a potential trend change to the upside, at least for a couple months. And look, after that breakup higher happened, look at where price found its support, with RSI holding right in the bull market zone. Okay. So now we move along, and we've got extending out into the bear market resistance zone. Now, if you're like me and you're very I would say, I guess, a very particular student, then you might be freaking out that I'm telling you that this is stopped in the bear market zone when it's spiked above it. Okay. Well, there are ways to measure the duration of how long it's been in and out of the zone to then determine if the signal is still valid and just had kind of a whipsaw, but we don't have time to get into that now, so just hold that question. But you can see here, June 2016, we've got this high at 70.61. This is a traditional sell signal. Okay, so they do work. But look here, we came back to 30, whip back up. Okay, fine. And now you're like, all right, Hema, what do I need you? We got RSI oil sell at 70, RSI oil buy at 30. Well, now let's look at a couple of things. When this started to consolidate towards the end of last year and just be like very hard to figure out what this was unfolding into, look here, you got this rally into the bear market power zone, okay, 65.16. I mean, that's pretty much 65. And then you've got the next resistance high coming in at 65.65, and then the next couple days it came in at 63.51. Okay, now this is like the third time I've showed you this setup. So we need to make sure you know what it is, all right? So let's go back to our just very clean representations of price and momentum. We've got price trending higher and momentum trending higher, right? They're supposed to move together. But the catch is when they don't, that's very, very telling. You see here, guys, this red line is showing a higher high in price. Okay, it doesn't matter what this price is, the price of anything, and a lower high in momentum. This is called a bearish divergence or negative divergence. And this is a situation where momentum is pulling away from price, and price is pulling away from momentum. That's usually the sign that the underlying force in the trend that we're seeing in price is shifting, and that you may want to watch out for a peak and a reversal. So you've got a higher high in price, but at the same time a lower high in momentum. Okay? Give me a BD in the chat room here if everybody's getting it. Bearish divergence. Okay? If you understand this concept. It's on other indicators too, I know that, but you know, my hour here is focusing on making sure you guys understand what I'm showing you. So, great. Now moving on, got a downtrend and this push lower. Well, bearish divergence has a bullish divergence counterpart. You've got a lower low in price at the end of a downtrend and a higher low in the RSI. Okay. So everybody got the basic idea of bearish and bullish divergence. Well, let's keep that in mind as we look at the zones and continue on. So we've got this CL here, and here was a bearish divergence. Okay, higher high in price, lower high in the indicator, oscillator. So what happens is this, bearish divergence in the bear power zone. This is like a double whammy situation, all right? So you want to make sure that you know what kind of divergence you're getting where. And in this type of setup, oh, I didn't plop it down here, but I have on the next slide, you would be tightening up your stops if you were long. You'd be looking for sell opportunities. Okay, this is the type of setup where you can be actionable to the other side if the reversal actually happens. Now let's keep going. We've got a double bottom that formed right at the traditional 30 overbought levels, right, 29.98, right, pretty close, and into the zone. Then we have another rally. This came right into the bear zone. So bear market resistance at 65 to 55. We got 64.45. Got a nice candle here that had a long shadow to it. A lot of consolidation. But look at this consolidation for, oh my God, this is like last year into early this year. Look how the bear zone just held all of it, okay? Like all this red area, like it just could not get above that. And then it broke lower. And when it broke lower here, we've got this reading of 24.65 and a bullish divergence, right? Higher low in momentum, lower low in price. So when you have a bull divergence in the bear support zone, this can be a little dangerous, okay? It's okay to exit your shorts. It's okay to tighten up stops on your short positions, but I would not enter long. You might miss the upside move. Yes, that will happen in life, but guess what? If you haven't figured out yet, you are going to miss some trades now and then. The important thing is not to get every single trade. It's to have your system applied for the trades that you get in on under your decision and control. So I'm telling you with these zones, don't enter long when you have a bullish divergence in the bear support zone, because it's usually just not worth the effort unless your whole point in your strategy is to scalp. Well, then that's something else. But moving on to oil, we're almost done with oil here. We got a rally back, 67.05, all right, probe just above the bear market resistance zone, but it did not get to the traditional 70 level. You see that? You see how people who are watching oil, just like you, watching the RSI 70-30, 30-70, they are going to miss that because they're waiting with their arms crossed for it to get above 70. It doesn't happen necessarily. And it's how beautiful is that this April 12th high came to the trend line of these old lows. And then from there you had a nice swing down. Not nice for oil investors and people on that side of the market, but in terms of a trend move and something very tradable, you had this push down in deep into the bear market support zone. Okay, rallied back. I mean, this just kept going on, and now here we are in the bear market support zone. Does that mean it's going to just rally back because it's in that zone? No, price needs to follow through and tell us. Now, I want to just take a little break for a second and jump away from futures. In my analyst days, people were very, very into biotech stocks. I mean, obviously they move a lot. So let's take the IBB, all right, which is an index of biotech in the NASDAQ, and just to see how this applies, because now we're on a weekly chart, all right? Look up here, weekly chart. So this is like a couple years worth of stuff. This move in April of 2015, this low formed with the weekly, so 14-week RSI basing in the bull market support zone. Rallied, met the bull market resistance zone. Is this starting to seem clear to you guys? Do I need to say the numbers every single time? Are you able to follow my red and green lines? Can I get a yes? Okay, because I see the clock here and I don't want to keep us all here too late. Now, again, what is this called? Can I get a lower high in the momentum, higher high in price? Anybody tell me what that is called again? All right, it's abbreviation BD, but now we've got two types of divergences. So is this a bullish one or a bearish one? Right, good. Okay, bearish ones, yes. Thank you, Helen. Thank you, Kay. All right, excellent. Now, bearish divergence in the bull resistance power zone, just like its counterpart, is a little dangerous. You want to make sure that in this situation, you can use it to exit longs if you've got them, tighten up stops on longs, but I wouldn't necessarily enter short. Does that mean you're going to miss things? You might, but it's the safer move until you layer in other tools and analysis. But if you're just going off the zones, this is what you do when you see this setup, right? Bear divergence in a bull power zone. And here you had a choppy unfolding from there. I mean, this is a very big volatile move to the downside. But now look at these past few months here. We've got all this churning sideways, higher highs, lower low, like it's just all over the place. And it's stuck. It's stuck between a rock and a hard place, which in the land of power zones is between bear market resistance and bull market support. It's like, what do you want to do here? It's confused. The market's confused, and this would be a warning sign. If you're seeing this on a weekly chart of anything, I would say stay up. But guess what? Most trends, whether sideways, up or down, come to an end sooner or later. In fact, all do. But this one, just this week, okay, this chart, I mean, these charts I grabbed yesterday. Jeanette knows, okay, made her nervous, but I knew what I was doing. This is the weekly bar from the IBB yesterday. Now, what do you do with this? Okay, Hema, you know, this is a weekly RSI power zone, great. But how do you actually trade that? Well, let's just go and jump to the 15-minute chart. Because look, at the weekly chart, your upside now is going to be for momentum to get into that 80 to 90 range. So you want to watch price move up as this does it. So we've got the IBB, we've got smaller time frame here, and on this 15-minute chart, we crossed a couple of highs. Okay, so that was first indication that we might be breaking out of this pattern. Churned, and look at this. I didn't even mark it because this happens just so often. We've got this peak here happening, this peak happening, all in the bull market support zone, or excuse me, resistance power zone, telling you, hey, there's bullish force picking up in this thing. And you got a chance to buy on the correction from that. Okay, this is just this week. This is real stuff. This is not pulling from old examples. So this would have been an opportunity to enter long if you felt confident in this break and had other tools combined with it to add confidence. And again on Friday. Okay, it wore itself out, and you could have been more aggressive and come in on a retracement, close of a gap. I mean, as somebody who's been looking at charts for so many years, I see 100 different things flagging me here as to why support may have occurred. But the important thing is, well, what's actionable? Well, look here. Higher low in the bull market support zone after holding the bull market support zone, very minimally trading below it. Okay. So with where I am on time, I'm going to go through the next two super quick, but trust me, there's endless examples to these, and depending on how things end, we can jump to live charts. Otherwise, I'll definitely do that down the road. But with the NASDAQ, okay, how many of you trade the NQ? You maybe don't trade the E-mini, but type in NQ if you trade it, or YM, because those are my last two examples. All right. So unexpected market activity following the U.S. election, all right? This was that spike. This is back to a daily chart. But look at this after the spike. This blows my mind, okay? You have the spike, the Trump spike, the Hillary spike, like whatever you want to call it. It happened. Everyone was confused by it. The decision is final. This is not like the latest season of House of Cards. If anybody watches that, I don't want to ruin it for you. But we knew who was going to be president. And we come here and we are chunking through, and look at this. You got 40 to 50, 40 to 50, 40 to 50, all right? All of these support zones coming in. RSI went above 70. You would have been on alert to sell, but then you had yourself powering through until it came to this zone up here. So you want to use these zones because they stop you from getting bearish too soon in an uptrend or getting bullish too soon in a downtrend. All of this stuff unfolded. The RSI worked itself off and then found support again in the bull zone. And then you went higher, back to 80 to 90. And then another election happens, France. And in like the course of 5 sessions here, 5 days, you went from the bull market zone to the bull market support zone. Okay, from power resistance to power support, and then boom, back up again. Okay, and then the last one here. So we got bearish divergence and bull resistance zone. I had already told you can exit longs or tighten stops, but don't enter short. It's a little dangerous. And then the last example here is a little snip of a 2-minute chart. So I make the point that this happens on any time frame. Price double top. Okay, these two highs are matching. Price breaks below, and this is all happening on the 2-minute RSI 14 period bear resistance zone in place. Fell down into the bear market support zone. So now you get out and buy, right? No. You don't buy just because you came to support and sell just because you came to resistance. You've got to watch what's happening here. And the thing is, on a 2-minute chart, you can see a lot more of these waves unfold. So here, you got oversold. It wore itself off, but look, it hadn't really rallied back that much. So you just have to still be careful. And if you were, then this is a situation where you'd maybe exit a short or tighten up stops, but I wouldn't just enter for long because of this, because we're basing in the bear zone, not the bull zone. And then this is what happened. You fell real hard here, okay? So these are just a few examples of the way these power zones have worked for folks. I'll read you real quick this testimonial from my friend Andy, who's been following my work for 6-7 months now. I trade the mini S&P, the ES, and I've learned not only about how HEMA uses the ES, but studied all kinds of markets with her tools. And this is a part that I loved when he said, she has shown me how the RSI can be used in a way that's like nothing I've ever seen, and it definitely gives you a better heads up. I mean, that's where I got inspired to label heads up for momentum, because I thought that was a great way to say it. I've even changed my settings in my software to match HEMA's RSI. It's been really become an everyday tool that's helped me lose less on trades that have been stopped out and squeeze more out of winning trades. Okay, both of these are more. Lose less, squeeze more, right? So with that, keep time here. I want to show you. This is a very important date for you all to write down. 7/11/17, my RSI Power Zones workshop. Okay, 4:30 p.m. Eastern. Let me erase all these highlights for you. And here's what this workshop's going to cover, right? It's going to be 2 hours, and it's going to pull from my 15+ years of experience, targeting 100% content during this time, 0% hype. And that's just how I roll. If you're looking for me to tell you, oh, well, you know, Gann discovered the secrets of a universe and here they are, that's just not how it's going to be, because it took him a lifetime to sort this out. It's going to take you more than one workshop. But what you learn, you can definitely put to work right away and use to improve your trading. In addition, You're going to supercharge your trading by learning about my favorite RSI pattern setups. Momentum is just like price, so you can use patterns on it constantly. The best candlestick patterns that I use for trading with the zones. You may have noticed that every chart I showed you was candle chart. They're very near and dear to me. I've been studying for a long time, and I've narrowed down to a few specific patterns that are very reliable against these zones. Bar chart reversal signals as well. Sometimes it's better to use a bar chart and not a candle chart. Live examples and more, right? You can't list everything on here and walk you through every detail, but everything that I use to emphasize the power of the RSI power zones will be touched upon in this workshop. Now, this workshop's July 11th, right? Today's June 24th, so you're going to get examples of the power zones daily. 30 days of my skinny on the mini, right? I still write it. Remember, I've been writing it for what, 12 years. And every single day, my power zones are included in there. And then now you get analysis of the S&P futures, and this is starting immediately on Monday. And then you are going to get these examples leading right up to the webinar and then continue after. I designed it this way on purpose. It's because July 7th is a very important cycle date in the markets, and I want to see that hash out so that you have examples that's going into it, and then we can revisit all these markets after that. Also, you'll get my indicator file, which currently I have for TradeStation users, and that will be part of what you get in this package. So your special offer today for being part of the Toast to Traders event is my RSI Power Zones workshop. It's $297 value. 30 days of the Power Zone examples by getting my Skinny on the Mini report. That itself is $49 per month. And then you're going to get RSI Power Zones indicator file for TradeStation, which on its own would be $97 value. All of this gets close to $450, but you will get it today for $97 by visiting hemaready.com/mama. Okay? hemaready.com/mama. I mean, I didn't do the math, but if you're paying $97 and you're getting from 15 years of my experience, I think it's a pretty sweet deal. And you know, a couple reasons why you need the workshop and not just what I showed you today. What I showed you today on its own can be useful, but it's not as great as having detailed strategies on trading around this indicator. Preventing yourself from reinventing the wheel. Okay, you don't need to go spend 15 years using this thing to figure out what I have. And save yourself time and money in the long haul. So again, hemaready.com/mama. If you have any questions or technical issues, you can email support@hemaready.com or contact the TradeThirsty team. So again, to sign up, follow the mama. Got to bring it back to the ducks. hemaready.com/mama. Thank you so much for your time today. Really appreciate it. And I will answer questions over email if you really have burning ones. Otherwise, come to the workshop. Okay, it's a great deal, and we can get into your questions there. Thanks again.